Hello and welcome to Core Wealth's monthly wrap-up for July 2019. In thinking about this session, I had a look at some of the things we've said earlier in the year. And at the beginning of this year, we were expecting economic growth of between 1.5% and 2% for the South African economy. Subsequent to that, we saw the very poor first quarter figures coming out, which were strongly negative. And the projections for the year now are probably a whole % less than what was predicted earlier in this year. So not good news. This month we saw employment figures coming out. They were worse than expected. More people are unemployed in South Africa than they were previously. One of the worst employment rates actually in the world. In addition to that, we saw the rating agencies on the back of these and other concerns, particularly around Eskom and the funding of Eskom, downgrading the outlook for South African economic growth. Once again, another negative. If you add on to that what we've seen globally, we've seen Boris Johnson being elected into the Prime Minister role in the UK, and he being quite adamant that he's going to exit the UK from the European Union by the end of October, whether they have a deal on the table or not. It's something that's making the world economy quite jittery. Add to that the trade wars, and these are having particularly strong impact on South Africa because we are an emerging market, and the trade wars are affecting China, obviously, in particular, as the trade wars go on between Donald Trump and China's Xi Jinping, and the knock-on effect to emerging markets has been very negative. Now, these are all things that make us nervous and have a negative effect on how we feel and potentially on investment markets. The problem that we have when we look back is that we often have the sense of immediacy and giving too much attention to things that happen in the short term. While it would be great if none of these negative things were happening, one often forgets about some of the positive things that are coming through, and particularly the longer term impact that some of these positives could have. Another interesting announcement that actually, or the data that came out this week, not an announcement, data that was released this week, showed that we've seen an increase, albeit relatively small, but we've seen a 1% increase in the amount of tenders being issued in the water project or for water projects, and a 6% increase in the amount of tenders or the value of tenders for roads. One of the other areas where we are seeing some further positivity into the future has been the amount of foreign direct investment into South Africa. Now we pulled some World Bank data showing that we've seen in 2018 we saw almost as much investment from foreign direct investors as we'd seen in the prior 3 years. Now those are things that we won't feel the impact of immediately, but going into the future, into the longer term future, we'll see some good impact, and those things will be positive from an economic growth point of view. Now, over the last month, very short period of time, we've seen further volatility in the equity markets. Local South African equities were down over the month, just over 2%, but still year to date, close to 10% return on the local stock markets. Globally, they were up about 1%, and we've seen the global markets now being up, the developed markets being up over 15%. This compared to South African cash over this period of time of only around 4% year to date. In fact, lower than that. For the 7 months, just below 4%. Now, we often focus on this thing of having exposure to equities, and the reason for that is quite simple, that you need equities to generate the growth through time. It's definitely not in a straight line. Markets go up and down, but we need exposure to growth assets in order to make sure our wealth is growing after we adjust for inflation. Now, if you compare cash, for example, over the last 50 years, your cash would have grown over a 50-year period after adjusting for inflation by only 1.6 times over the 50 years. Compare that to shares over the same period, shares would have grown by 22 times their initial value after adjusting for inflation. Now you might say, well, 50 years is far too long a period, and we've looked at that data over shorter periods of time as well, and a similar picture emerges. This is the reason why it's important to have a diversified portfolio, that you have some cash in it for a long-term portfolio, a small portion, but that you have global, local equities included. You'll have some bonds in your portfolio, some listed property as well. I hope that's been helpful and given you some insights into how we're thinking around the future for investment markets, but also I hope it helps maybe put into context how we should be reacting to some of the negative news which mostly fills the headlines, unfortunately. And some of the more positive things only tend to come out much later. Now, if you have any questions, as usual, please by all means drop us an email or give your financial advisor a call. We'd be happy to address any specific questions that we're having. We are about to have one of our big questions events that's happening later in August, and if you're able to make it to that, I look forward to seeing you there. Thanks for watching.